Hello and welcome to this week's Australian Stock Market Report. This week we'll look at why you do not need to be worried about the market ever. Then I'll get into the market so I can share with you my thoughts on the Australian stock market, where it's heading, along with answering all of your questions and looking at stocks for you. Hello, I'm Dale Gillum, the Chief Analyst here at Wealth Within, and we are Australia's most trusted stock market educators. Before we move on, thank you for showing your support for our channel and hitting that subscribe button. As you subscribe, click that bell on the right of it so you keep up to date with our latest videos. Also, remember to tune into our live Australian stock market show every Tuesday, 7 to 8 p.m. Australian Eastern Time. Now, this is the show where you get to ask us, the stock market education and trading experts, to look at your favourite stocks and answer all of your questions. Over the past month, I've seen investors go through a myriad of emotions, from disbelief to fear and then greed. Right now, investors are looking for certainty in an uncertain market, with many asking whether the market has bottomed. Is this stock cheap, and can I buy it now? The more concerning question I'm getting right now is from those who own stocks and are losing money, wanting to buy more because they believe the stock is cheap, given it's fallen heavily. It's one thing to attempt to bottom pick stocks that have fallen heavily, but it's another thing altogether to increase your risk by buying more of the same stock that you're already losing money on. But individual investors are not to be blamed for following the concept of dollar cost averaging, given that it dominates the financial services industry investing mantra, despite it not delivering the results it claims. Dollar cost averaging involves placing funds into an investment at regular intervals over a period of time, regardless of whether the market is moving up or down. But this practice can significantly impact the performance of portfolios, and not necessarily in a positive way. According to industry experts, dollar cost averaging reduces the risk of investing in volatile markets. Yet right now, we are in a very volatile market and people are losing money. The issue I have with this concept is that the industry promotes this practice, stating that it helps to avoid the so-called pitfalls associated with timing your entry into the market. But I would argue otherwise, because this strategy is very questionable when markets are falling heavily, as you are subjecting your portfolio to a higher level of risk, which is exactly what you want to avoid in a volatile market. In my opinion, adding to an investment that is falling in value increases risk and should be avoided at all times. It is far better to wait for the dust to settle or buy an investment that is rising in value. So what were the best and worst performing sectors last week? Well, with another shortened week due to Easter, the market was a little subdued. Last week, information technology led the way, up over 6%. Industrials was also up over 6%, whilst consumer staples was up over 5%. Now, after rising the prior 2 weeks, the energy sector fell away to be the worst sector for the last week, and it was down 2%. This was followed by financials, barely up, rising just 0.2%, and communication services, which was up around 1%. Looking at the ASX top 100 stocks, we see Adelaide Brighton was the best performer, up over 13%, and this was followed by A2 Milk, up over 12%, and surprisingly, AMP was next up, over 11%. I say surprisingly, as AMP has fallen over 80% in the past 5 years, and every time it's tried to rise in that time, it's failed, so don't get too excited about that one. Now, the worst performers so far last week include Whitehaven Coal, down over 10%, Flight Centre was down 9%, and Coca-Cola, well, that was down 8% last week. So what do I expect in the market moving forward? Well, let's get into the charts of our S&P 500 All Ordinaries Index update for this week. We'll also answer your questions and look at the stocks you've chosen for me.
Please remember that this report is an educational tool. While Wealth Within holds an Australian financial services licence, the information featured in this program is general in nature and therefore should not be relied upon. Before making any investment decisions, you should consult a licensed professional who can advise whether your investment decisions are appropriate for you. We hope that you enjoy this week's report.
Well, last week the market continued to trade up, and a lot of people are asking me, hey, Dale, can you confirm the bottom on the 23rd of March? is actually the bottom, and is the market now bullish, medium, long term, short term? I'm getting lots of questions around that, and it's interesting during these times that people do ask me about that sort of stuff, wanting that confirmation. And that's really why I sort of said at the start here, you don't really need to be worried about the market. It's about having rules, and then you don't need to understand where something is at the bottom or whether it's at the top. Is if you've got rules around buying and selling and managing your portfolio, then I don't care whether the market's going up or down. I have rules to manage that. And so to me, if the bottom's on the 23rd of February and that's the confirmed bottom, and let's say we're in a medium term uptrend for now, that's okay for me. If it's not the bottom, that's still okay for me, because I have rules around that. And that's why I said you don't really need to be worried about the market. And I find a lot of people during these times of uncertainty, their lack of knowledge and, or dare I say, ignorance of the market shines out like a lighthouse, where they don't really know where they're going, where there's understanding how the market works and just having some rules around that will make sure that you not only get good profits, but you protect your capital. But you don't really need to ask questions like, has this stock stopped falling or has the market stopped falling? But let's go and have a look at the chart right now and see where the market is at, and I'll give you my thoughts on where I think it's going to go. So looking, as you can see here on the chart on the screen, that's a weekly chart of the All Ordinaries Index, and you can see that low there of 4429. That was the 23rd of March that we hit that low, and so we've been rising up ever since. So we've had 1, 2, 3 weeks. But look at this big bar here. We can see the range here was, of that bar, was 523 points. The range of this bar is 357 points. And the range of this bar is 217 points. So less than 50% of the range of that first bar. So what we're seeing here is the market slowing its momentum. It took off pretty quickly. We had that second week where a lot of people were jumping in trying to bottom pick. And then last week we saw a much smaller bar. It did close high, so we're seeing the close right up there, and it's closed above that 5,521 points, which I think is a good sign, but it's not enough for me to say, yes, that low down there on that 23rd of March, whether that low is the low. Now, we do need the market to turn around and test that low. I did say a few weeks back that I thought the market would rise to from 1 to 4 weeks. The longer it rose in time and price, the better it would be for me. For me to start getting excited, it would need to get through that 5859 points. It would need to do that this week and into next week. And if it did do that, then I might start changing my opinion. But I half suspect our market will fold over in the next, either this week or into the next week, and start folding over and then coming back to test that low of the 23rd of March. It's a probability, it's not a guaranteed. And I know a lot of people, like I say in my report, people are wanting guarantees right now, and people are saying to me, well, you got that sort of wrong, Dale. Well, you know, are you going to be right moving forward? In the market, you can never be 100% accurate. It's only about probabilities, and that's what I keep saying to people. And you need to look at the probabilities. If something is 7 times out of 10 going to happen, then 3 times out of 10, it's not going to happen. And that's why I keep saying to people, you need to have a plan. You need to have a strategy. Why are you buying? Why are you selling? How are you managing it? What are your rules around buying? What are your rules around selling? What are your rules around your money management and your risk? And 99% of people, investors, don't really have any rules or any solid rules. And a lot of people delusionally think they actually have some when I start asking them questions. I find that they've got no real rules at all. But knowledge empowers you, and that's really what I'd suggest you do. Read my book, Accelerate Your Wealth. You'll have those rules around buying, selling, managing, position sizing, portfolio construction. And people that have read that book really are sending me lots of emails nowadays saying, thank you very much. You've helped me a hell of a lot to understand and why I shouldn't be worried about the market right now. Where I think it's going to go, as I said, it could go up this week, but I'm betting right now the probability, the more it rises, the more the probability is it's going to fall away to test that low. And I think we might be sitting here next week saying, hey, the market's gone down for the week. But let's get into your questions for this week. And we've got a few ripper questions this week, so let's get into those right now. Now, the first question we have today is from Lincoln, who says, hi, Dale, just started looking at investing and was thinking about SHLX, or Shell Midstream Partners. And that's an interesting choice if you just started looking at investing, mate. It's gone down 46.52% in the yearly performance, and is paying a 15.81% dividend yield. What do you think about this stock? The 15.81 dividend yield is simply because it's fallen so heavily. If you go back to a period before it fell 46%, the dividend yield was more like about 6 or 7%. Dividend yield rises as the stock falls away, and whilst it sounds attractive to have, it's not. There's a reason that stock's fallen a lot more than what the actual market fell. Remember, the market fell about 37 or 38%, and this has fallen 46%. My guess is that the dividend yield, it won't be sustainable like we're talking about with the banks. I don't think that some of those high dividend yields are sustainable. If companies aren't making the money that they were making last year, they will reduce their dividend yields, but it looks attractive at the moment. I mean, where do you get 15.81% dividend yield? But if you lose money, let's for example saying you own that stock prior to the fall, that 46% fall, you've lost 46% to get 7 or 8%. That's not smart investing. But let's go and have a look at the chart. I would suggest you'd actually stick with the top stocks on the marketplace. If you're just beginning, really do look at the top stocks on the marketplace. Don't look at stocks like this. But here is Shell Midstream Partners, and you can see the whole history of this stock, and obviously its all-time highs back in June 2015. Now if I put my little tool on this one, if I can find my little tool, and it's not there, where is it? Let me get to this one, and you'll see exactly what I mean. If you see this, it's fallen down to that low. There's 88.55% it's fallen from that high back in 2015. 5 years falling away. Now you're saying it's fallen 46% more recently. That would have been from that high there. From that high here, it fell down 74%. To that low there was 56%, so from that it's now 49%. So that's fairly heavy falls. None of this is telling me that this stock is looking bullish. If you go and study, I'm assuming because it's Shell Midstream Partners, it's got something to do with the oil industry. I've never studied it, don't know, but looking at oil at the moment, oil is looking terrible. So if it's got anything to do with oil production or oil products, it's not got a lot of hope of doing very, very well at this point in time, because I've looked at all the oil charts, you know, looking at light sweet crude, I've looked at West Texas crude, I've looked at heating oil futures. They're all looking pretty ordinary at this point in time, so I don't expect oil to rise up anytime soon. And if, you know, looking at this chart, it doesn't really tell me that this stock is looking bullish at all, or even a chance of looking bullish at the moment. Even last week's bar it's showing me a little bit of signs of weakness there, so stay out. I'd be looking at top 50 stocks minimum, and that's what I wouldn't be going outside of that. This is not a top 50 stock, so just if you do really understand or need to understand what to do, just buy my book. $30, it'll save you a lot of money, it'll help you out and give you a lot more confidence in knowing what to do. Next question we've got from Mr. Corona, who says, hey Dale, how do you interpret negative balance sheet? Weird that I saw some companies having negative balance sheets for a few years already, and no one is speaking up about the risks of bankruptcy. Am I getting something wrong? Look, I don't look at balance sheets at all, and it's probably strange, and a lot of the fundamental people out there are going, Dale, how do you make the market, or how do you analyse the market when you don't you don't look at those balance sheets and the fundamentals of it? We use fundamentals, and I do that, but I'm really, really sparse on my fundamentals. Like fundamentals, how do I say it? If you're looking at long-term investing, like 3 to 5 years plus, fundamentals are far more important than if you're looking at anything under that sort of 2 years. Fundamentals become the closer or the shorter the time you want to hold, the less the fundamentals are valuable to you as a trader. Like if I was day trading, fundamentals are pretty much irrelevant to me. But trading medium term, they are of interest to me, and there's a few metrics that we actually use, like PE ratios, dividend yields, EPSs, look at debt to equity ratios, but we don't look at the balance sheets. And just looking at companies, their balance sheets can be negative for years and years. I mean, look at Uber. Uber's had a negative balance sheet for so long. There are lots of other companies that have had negative balance sheets for a long time. They just go out and raise more money because they're building their business and everything else. So, and that's why negative balance sheets don't tend to, I suppose, they don't get my attention too much. That said, I don't generally buy companies that have negative earnings either, so that would tell me the same thing. But even looking at Uber, and when you look at that, it's got 3 divisions, 2 of them making money. Obviously the ride sharing part of it's not making money, but they were expecting that to come into profitability, and then their balance sheet will turn around. But that's probably the highest profile one that I can think of, but there are many companies that are rising on negative balance sheets. It's just the perception of what might happen into the future. That's really what it's about. So the next question we've got is from Christian, who says, "Hi guys, I'd like to thank you for your efforts in putting together such professional, informative content. It's provided me with some great insights." Thank you. Could you please have a look at Woodside Petroleum? I purchased at $18 and I'm looking to keep this stock for the medium term. So we'll have a look at that. I've also researched that Woodside is producing the first offshore development in Senegal. That's in West Africa. I work at the Sangomar field development commenced in early 2020 with first oil production is targeted in 2023. That's irrelevant to me, really is. It's at the moment. He says, thanks for your analysis. Looking at oil, as I said a little bit earlier, oil is not going to go anywhere, and so them looking at another, they're obviously doing production in 2023. That's speculation in my book. It could take them to 2025 or 2027. It's unless it's happening now, I treat that as speculation, and that's where a lot of people jump in really early on some stocks thinking, hey, they're drilling now, they expect to do this, but that's where a lot of mining companies can be a lot more hit and miss. But let's go and have a look at Woodside for you. Again, I've already made my comments on oil, so I'm not expecting Woodside to be very good. Here's Woodside. Look at it. It's just looking terrible at this point in time. You're seeing how far it's fallen. It's been falling generally since May 2008. So get that into your portfolio and see how that works over the medium to longer term. You'd be just collecting dividends while you're losing a shed load of money, and I really do mean a shed load of money on Woodside. I'm not saying it's a bad stock. I'm just saying this is a trader's stock. So unless you understand what you're doing, you'll struggle with that. That's down 78% to that low, and from that high now it's down to the current close around 68%. Looking at it on a weekly basis, we can see it's risen up a little bit with the market, but this is a little bit more bearish, this last bar. So again, I'd stay out of Woodside. I'd be staying out of anything to do with oil, that oil industry, because energy, you're going to have to look. I mean, I talked about energy a little bit earlier in the report. It's the worst hit sector this year, so that doesn't necessarily make it a good bargain just because everything's fallen so heavily. Eventually it'll stop falling, and eventually it'll find support, and eventually some of these stocks will do all right, but there are other stocks that you could be buying that will do better than this stock, and it'll be a bit safer. So but thank you for the question, and thanks for the support on our channel. Now, next question we got from Courtney, who says, thanks for the updates, investing from New Zealand. Fantastic. Thanks, Courtney. I love going to New Zealand. I wish I could go over there now, but it's a nice place to visit. But she's going, have you got thoughts on Atomos, which is called stock ticker code AMS, and ZIP or Z1P. I'm not going to look at ZIP. I've looked at that so many times over the last few months. I'm sick of looking at it. But I will look at Atomos, AMS right now. So, but you don't tell me whether you're buying it or you own it or you're not looking to own it, that sort of stuff. But right now, like I was saying to these other people, it's, you know, if the person who bought Woodside at $18 would be a little bit stressed right now because I don't think it's a good buy, but I'm not telling them to sell. But looking at Atomos, let's bring it up on the screen. Z1P's done reasonably well. Atomos, I don't like this one either. It's probably straight out. It's not hasn't been around very long. It's a little bit harder to look at. Looking at it from here, it's not really. If you see what it's done the last week, where the All Ords made a new high. This week's bar on, or last week's bar on Atomos was lower than the previous week. It shows it doesn't have the same strength as the actual market itself. Let's go down onto a daily chart just quickly and have a little bit of a look at it. Looking at this stock, we're seeing, you know, 500,000 shares traded. It's a low liquid stock, 500,000 shares traded. So for $500,000 will move is the whole day, basically. So pretty much anybody can move this stock, well, not anybody, but there's 600,000 at around 60 cents, so $300,000 to $400,000 of daily volume in terms of, so that's not a lot when you're talking about in the big scheme of things. I'd be looking at, you need to be looking at $2, $3, $4, $5 million minimum for any stock that you're looking at, but right now I don't think this one is a smart buy. I think it's, I'm not saying it can't go up, but right now it looks like it's more bearish to me. But thanks for the support from New Zealand. Let me know where you are in New Zealand, because I've travelled a lot of New Zealand, and we do have a lot of New Zealanders, Kiwis, on the channel and asking questions. So stay safe over there. You're doing a great job with this COVID-19. I think your Prime Minister's doing a much better job than Donald Trump is, that's for sure. The next question we've got is from, I think you say your name as Joran. And he says, "Hi Dale, I'm from Brisbane." Welcome, Joran. Awesome content as always. Thanks, buddy. I'm holding most of the top 10 companies on the ASX, and I've just received some sweet dividends. Now that's good. I'm glad you're looking at the top 10 companies and you're holding those. My question is, do you think I should hold the dividends in cash and wait for a buying opportunity, or have them get into a reinvestment plan and forget about it? It sounds to me from what you've said is that you're more of a buy and hold person because you've got the 10 stocks. You're looking at dividend reinvesting plan. I don't do dividend reinvesting plans at all. Janine doesn't do them at all. Part of the reason is because when you do dividend reinvesting plans, you can all sorts of things can happen. It depends on if you're buying hold. What happens is you slowly get more and more stocks at multiple different pricing. So when you do eventually go to sell them, you have a capital gains tax nightmare or tax nightmare simply because you've got multiple different position sizing. So it makes pretty much makes your paperwork a lot more of a nightmare. So you need to keep everything and record every single share at what price you paid for it. I've always been better, let's get the cash and then put it into the bank account, and then when another opportunity comes up and we invest in that. That's more of our philosophy. That way you manage the position from start to finish. If you're more of a trader, then definitely I'd be saying don't do dividend reinvesting. I'd just be buying the shares and selling them out and putting the money in the bank. And I'll tell you a bit of a story. I trade News Corp all of the time, and News Corp never paid much of a dividend. I used to make a lot of money out of News Corp trading it all the time. And for I think for 5 years I had one share in News Corp, because I'd buy News Corp, trade it for 3 to 6 months or 9 months, sell it. It'd pay a dividend after that, sometime around that. And sometimes it was just cash sitting in the bank, like a few dollars. Other times it would say, I'd get a statement saying, hey, you've got one share in News Corp on a dividend reinvesting plan. That's part of the reason why I don't do it anymore. So I have this one share for a year or 6 months until I bought it again. So I think for 5 years I constantly had one share in News Corp, which just made it very, very annoying. I'd rather just sell out, go into another company, and that's what I'd do. But thank you for your questions, and I really do appreciate that. And thanks for everybody sending in your questions, and thanks for watching till the end of this video. But if you have a question that you'd like me to answer, please just stick them below. I will get to answer them, so please get your fingers on those keyboards and get typing questions. Remember that here on this channel we do these market reports every single week. We also do a live stream every Tuesday night, 7 to 8 p.m. So see you on our live stream tomorrow night. Remember to hit the subscribe button now. Click the bell on the right of it so you know when we upload our latest videos. But for now, I'm Dale Gillum, the Chief Analyst here at Wealth Within. Goodbye, good luck, and good trading. Stay safe.